Welcome back. To recap some of the more significant economic reports this week, we first consider the New York Empire State Manufacturing Index. Declined to negative 9.1, worse than estimates of negative 5. This is an index of business conditions and manufacturing activity in the state of New York. Third straight negative report. Industrial production slightly higher, 0.4 versus estimates of 0.1. This measures the level of production and capacity in manufacturing. Capacity utilization, that shows us the percentage of the organization's potential output. That's at 80.3, a little bit better than 80 estimates. Philly Fed Manufacturing, it's a monthly survey of the manufacturers in the Philadelphia area. Second straight negative report, negative 8.7 versus a decline of negative 5. And existing home sales, 4.71. A little bit better than estimates, but much worse than the prior number of 4.78 million. Sales of previously owned homes declined to the slowest pace since 2012. So it seems that for the time being, manufacturing and housing are the weaker areas of our economy. Taking a look at the white charts at the bottom, that's the Philly manufacturing outlook on the left side, New York Empire manufacturing on the right side, steady trend to the downside. Capacity utilization is trending higher. Industrial production is trending higher. Take a look at the 30-year mortgage average, just a hair under 7%. Mortgage rates have been climbing very aggressively. And of course, existing home sales continue to decline. Very, very significant trend. This goes back to the beginning of this year, 2022. We've just seen a steady trend to the downside. Taking a look at the S&P 500, top left-hand side, every dot represents one stock in the S&P 500, showing us their each stock's relative strength index, RSI. Most of the stocks have an RSI between around 30 to 60. The right-hand side shows us the counts in terms of their histogram bars. Again, most of the stocks have a relative strength 40, 50, 60. So the market has somewhat of a neutral trend right now, but the bottom charts, the green charts, show us the S&P 500, but this time in respect to their own 52-week ranges. The vast majority of the S&P 500 is between the 5 to, let's say, 30 percentile of their yearly ranges. That means imagine if every stock had a yearly range of $1 to $100 a share, most of them would be trading under $30. So right now, while immediately the RSI, the relative strength index, shows us a somewhat neutral trend because stocks have kind of bounced in the past couple weeks, or at least past week or so, the overall look at the market, it's still very, very negative. We're right near the lows. So don't let the RSI fool you. Taking a look at the VIX, this is the volatility index, measures a premium on the short-term options on the S&P 500. This goes up when stocks go down. So as stocks have risen over the past couple days, the red line, the VIX, has retreated back to its 20 simple moving average. But notice over the past couple months, as the VIX has come back to the 20 simple moving average, it's bounced right back up to the upper Bollinger Band again and again. And this time, notice the Bollinger Bands are expanding. This expansion of the volatility is usually a precursor to a big move in the same direction of the overall trend. The same type of chart pattern also exists on the NASDAQ 100 Volatility Index, which again shows us the premium on the short-term options on the NASDAQ 100. So this is telling us that while stocks have gone up over the past week or so and volatility has fallen to some extent, the long-term trend I don't think has changed. And this looks like it might be setting up for a big move in favor of the long-term trend. VIX higher, stocks lower. Taking a look at one of our custom indicators over here, we can see the blue line represents our housing index. It's comprised of several different indicators to include the home price index, existing home sales, active listings, construction and residential spending, things of that nature. And the blue line has definitely ratcheted down from its near-term highs. The green line, even more significantly, is our growth index. That's comprised of retail sales, industrial production, capacity utilization, which we saw this week, non-farm payrolls, durable goods, etc. So that has declined. The red line is the inflation index. That remains the strongest, relatively speaking. So what this is telling us, inflation is strongest and growth and housing are weakening. I thought this was kind of interesting. The red line represents a non-farm payrolls going back to early July. The purple line represents the correlation, or I should say, the purple line represents the Indeed job postings, the number of jobs advertised on the Indeed website. Notice a correlation, very strong indeed. Indeed job postings go down, so does the non-farm payroll number. Very strong correlation here. Taking a look at the daily change in bonds, we can see the 3, 5, 7, 10, 20-year bonds are up around 1%, 10 basis points. The shorter term bonds, like the 1 year, 2 year, are up but less. This is a little bit of a reversion from the long-term trend that we've seen where short-term interest rates are going up more than long-term interest rates. It looks like it's a pullback in the bond market, which is logical because we've also seen a pullback in stocks and we've seen a pullback in the VIX. However, taking into consideration the big picture, I don't think that this is necessarily a reversion at all, or a reversal, I should say. The red line on the top right-hand side shows us the total bond yields. If you were to add up the interest rates for the 30-year bond, the 20-year bond, all the way down the spectrum, we would see interest rates just continue to rise. Money just seems to fly out of the bond markets and sending obviously the dollar higher, all in anticipation of higher interest rates. The blue line represents the S&P 500. It looks like we're forming a little trading range over here. I don't at all expect that this is a big reversal. I know there's a double bottom here, but double bottoms are often broken as well. Of course, it'll be left to be seen. If we do see the S&P 500 break above, I would say, the 3,800 level, this could be the beginning of a turn back higher. And of course, if we break below the recent swing lows, that could lead to much lower lows. But take a look at the 1-year bond, 4.66%, the 2-year bond at 4.62 versus the 10-year to 4.24. A very, very sharp inversion. Normally, long-term bond yields or long-term bond maturities have higher yields. Right now, we have a 0.42% difference between the 10-year bond and the 1-year bond. 1-year bonds pay a lot more than the 10-year does. And that is certainly something that we don't normally expect to see. The red line on the top, on the left-hand side, shows us the mortgage rates, the average mortgage rates, whereas the blue line represents a 10-year Treasury bond. And the difference between that is known as the mortgage spread. That's also depicted on the right side with a yellow line. In a strong economic climate, we usually see a small difference between the two as mortgage rates go up and the 10-year Treasury goes up. But now we see in not so strong of an economic climate, we see this mortgage spread continue to decline. The purple line shows us the S&P 500. And we can see there's actually a pretty stark correlation between the two. Not an exact relationship, to be sure, but there is a contraction between mortgage rates and the 10-year Treasury bond market as the S&P 500 continues to go lower. And this is an indicator that not only traders and investors, but also those invested in or watching the real estate market, they pay close attention to this, and this is certainly not a healthy sign, to say the least. Finally, the black line over here shows us the S&P 500. It's bounced off its recent lows, but certainly a long-term trend to the downside. The green line here shows us the difference between the short-term bond maturities. So the difference between the 1 year and the 2 year, the 2 year and the 3 year, for example. That has been very, very strong as the bond market has continued to invert, meaning short-term bond yields go up more than long-term bond yields. The spreads between the medium-term bonds, like the 5 and 7 year bond, 10-year bond, that's depicted by the red line, and the long-term bonds are depicted by the blue line. When the S&P 500 is strong, we tend to see the blue line go up, then the red line, and the green line would weaken. Now, the green line has weakened, but just notice the absolute difference between the two. And relatively speaking, take a look at last July, early August. The spreads between the green line, the short-term bonds, and the long-term bonds were really not that, not that spread out, so to speak. And that's why as the S&P 500 was climbing higher. But the bond market, the stock market, the dollar as well, mortgage spreads, all of these markets are really telling us the same story. Stock market has a long-term trend to the downside. Bond yields have a long-term trend to the upside, especially the short-term bonds. It has reversed over the past week or so, but based at least on current indications, I wouldn't interpret this as the beginning of a trend reversal. It looks like a reversion back to the mean, away from its extremes. But if history's any judge, until we reverse, the trend is your friend, and at least that's what the data suggests at this point. We hope this has been helpful. We wish you a great day.